Good morning, students. Welcome back to this discussion on accounting standards. Okay, so we have been discussing consolidated financial statements and we were covering associates AS23. Okay, so today we plan to continue on that and hopefully we should also be able to get on to our next topic, that is about AS27 today. Okay, so that is in respect of joint ventures. Yeah. Now, quickly, let's do a recap of whatever we have discussed in respect of AS23. So AS23 deals with the relationship between the investor and the associate. And when does the investee become an associate? When the investor has got significant influence over the investee. Okay. Now, what do you mean by significant influence? Significant influence means the investor has got the power to participate in the decision making. And for this, we also discussed that in some of the cases, when the investor will hold more than 20% shareholding, okay, so that is when you will just presume this significant influence to be there. Yeah. Further, the moment we say that investor has got significant influence, so the requirement of consolidation gets triggered. Okay, which means that the investor will also be required to prepare consolidated financial statements in respect of the associate. Now this associate will be required to be consolidated using equity method of accounting, which was different from what we discussed in case of holding and subsidiary. Yeah. Now, what is this equity method of accounting? Quickly, any thoughts? We talked about it. We didn't discuss this in detail, but quickly, everyone, what is this equity method of accounting? What are you required to do in case of equity method of accounting? Over to you. So what do you do in equity method of accounting? Quickly, over to you. So if in case there is an equity method of accounting, so what will you do? All right. So Hardik says net approach, only the investee share will be taken in respect of what? Anil says allotment. Allotment means what? So when you are following equity method of accounting, what do you do? Okay, so Hardik is saying in respect of assets and liabilities, so the proportionate share, or we can say the proportionate share of net assets will be picked up. Yes or no? Proportionate share of net assets will be picked up when it comes to equity method of accounting. Correct? Now, let's try to understand some of the associated points in respect of this equity method of accounting. Now, if you look at the consolidated financial statements, what do we have? We have the investment in the associate to begin with. Okay, to begin with. On which, if there is any proportionate net asset, that is something you will top it up with. Yeah. So that will keep getting added to that. Further, similar to what we discussed in case of holding and subsidiary, whenever any purchase consideration is paid, and if that is in excess of the net assets, or you can say the proportionate net assets, or if that is short as compared to the proportionate net assets. So we used to recognize goodwill or capital reserve in case of holding and subsidiary. I'm talking about AS21. Correct? Now, similarly, you are required to compute goodwill or capital reserve in case of associates as well. Okay. And any corresponding changes in the net assets year on year, what is going to have, what is going to be the treatment in respect of that? So that is something you will keep adding to the investment with which you begin. Yeah. Yeah. So this is briefly the approach we can say, which is required to be considered in respect of the investor and the investee, wherein the investor-investee relationship is that of associate. Okay. So now what we will do is we'll get on to the accounting requirements straight away. And in respect of accounting requirement, we'll just try to get some more insights about this equity method of accounting. Okay. So I'll just take you to one illustration now, and we'll just try to look at the accounting requirement. So let's look at this example. A Limited acquired 45% shares of B Limited on 1st April X1, for which a price was 15 lakhs. Okay. What do you mean by this price? This price means purchase consideration. Correct? You are also given the extract of balance sheet of B Limited. Now, what is B Limited? Can you tell me in this example? What is B Limited in this example? Over to you quickly. Yeah, so Pranav says associate. Very good. So B Limited is the associate, right? Okay. So we are given paid up equity share capital, security premium, reserves and surplus. And now this information appears to be in respect of net assets of the associate, because here again we'll need the net assets. Why? Because proportionate share of net assets is something we are going to pick up. Yeah. Further, it says B Limited has reported net profits of rupees 3 lakh and also paid dividend of rupees 1 lakh for the year ended 31st March X2. Means at the beginning of the year, when this B Limited was acquired, so the net assets are given. Then after that, 1 year has gone by and the profit or the dividend information is available in respect of that. You are required to calculate the amount at which investment in B Limited should be shown in the consolidated financial statements of A Limited as at 31st March X2. Okay, yeah. So this is something which you are required to compute. Means on 31st March, what is the amount which A Limited will record in respect of B Limited in its consolidated financial statements. Please remember, in its consolidated financial statements. Okay. Now, before we move on to 31st March X2, can you just quickly help me the amount which A Limited will record in respect of B Limited on the date of acquisition? Over to you quickly. What do you think will be the amount which A Limited will record on date of acquisition in respect of B Limited? Over to you quickly. I think it's quite simple. Yeah. Okay, so I think I missed some responses wherein you talked about associate. Okay, Tambeshwari is saying date of acquisition is 1st April 21. Yes, that's 1st April 21. Okay, Dilip says 6,75,000 will be recorded. All right. Now this 6,75,000 will be in respect of what? Can you tell me? Hardik is saying 4,50,000 will be recorded. Okay. What about others? What about others? Tell me quickly, huh? Okay, so I think Pranav is also getting 4,50,000. All right, so let's do one thing. Let's look at this example to begin with. Okay, and then of course you can just answer some of the questions that will follow. Right? Okay, I think Tambeshwari has got 7,20,000. Very good. Okay, so now on 1st April X1. Okay, so we are looking at this particular date to begin with. Why? Because on the date of acquisition, we'll just create the numbers and then we'll move the numbers to year end as well. On this particular date, what do we have? We have an investment in B Limited for which amount paid is 15 lakhs. Yes or no? For which amount paid is 15 lakhs. Now, as against this amount, some of the net assets have been acquired. Yes or no? Now, what is the amount of net assets of B Limited? That is 10 lakh. share capital, that is 10 lakh share capital plus 1 lakh premium plus 5 lakh reserves, right? So all in all, 16 lakhs is the total value of net assets of B Limited. But this total value has not been acquired. Yeah. Proportionate share has been acquired. So what is the proportionate share? 45% of 16 lakhs. What do you get? 45% of 16 lakhs. What do you get? Manvi says 7 lakh 20,000. I think same is the response from Pranav, Preeti, Tambeshwari, Ragini. Very good. So I think you are now on to this, correct? Okay, so 7 lakh 20,000 is the proportionate share of net assets which you get, right? So that means this purchase consideration is in excess. This is in excess. So the moment we say it's in excess, what do you get? What do you get? Goodwill? Yes or no? Goodwill? Right? Okay. Then I think Hardik has a question. Hardik is saying, but sir, the profits are posted after 1st April. Okay. So, no, so I think we are not yet done. Hardik, let's get done with this and then you will understand. Okay. See, this calculation currently, which we are looking at, is on the date of acquisition. Please understand, right? Question requires us to show how this accounting treatment or this entire thing will be completed, and then you'll have the balances as at the year end. But to begin with, this is, you can say, our opening number. Understood? Okay. So now we are getting a goodwill of 7 lakh 80,000. But this goodwill is on the date of acquisition. Please remember. Correct? Okay, now as we move further, so what will happen? As we move further, what will happen? We'll start with this opening balance. Now, what is the opening balance? Our opening balance is 7 lakh 20,000, means the proportionate share of net assets, this one, correct? Plus goodwill. Goodwill is also there on the date of acquisition, goodwill. And the sum total of this is what? Cost of investment. See, against that 15 lakh, what is it that A Limited acquired? Two things. One, proportionate share of net assets, and second, goodwill. Correct? Okay. Now this 15 lakh is there at the beginning of the year, right? To this 15 lakh, what do we need to add? Any change in the net assets which has taken place from the date of acquisition till the date of reporting. Yes or no? Now, do we have those amounts available or we need to calculate that? We have those amounts available. So what are those amounts? 3 lakh profit has been earned. So this 3 lakh, will it increase the net assets or decrease? So if you earn profits, so what will be the impact? Nitin says it will increase, correct? And out of this profit, a dividend of rupees 1 lakh has been paid. So what is going to be the impact of this dividend? Should we ignore this? Dilip says no. This will reduce the amount of net assets. So that means all in all, net assets have increased by 2 lakhs. Correct? 2 lakhs. Okay. Now, if the net assets have increased by 2 lakhs, then the proportionate share of 2 lakh, what is that? 90,000. 90,000. That will get added to the cost of investment with which we started, which is 15 lakhs. So that's why What is going to be your closing balance as at 31st March X2? That will be 15 lakhs 90,000. Okay. Yeah. Clear on this? Everyone clear? Yeah. So Sai is asking, sir, dividend paid post acquisition. So it should be it should be added to the investment or P&L. See, dividend paid post acquisition should be added to P&L. That is what we discussed. Remember? Dinesh is asking, sir, we should add 45% of profits and decrease 45% of the dividend paid. Yes. Yeah. Because any increase in profit will increase the net assets. But if you pay out something, then automatically your net assets will go down. Yes or no? Yeah. So clear on this? Everyone clear? Yeah. As to how this accounting will be done. So this is what you can say is the equity method of accounting. As simple as that. Yes or no? Yeah. Any questions on this? No? Everyone clear on this? Okay. So now there are few more examples that we can look at in respect of equity method of accounting because this standard is not that comprehensive. Something which we see in case of AS21. Okay, so now let's look at this small example. So this case scenario one. Here again, our idea is what to get on to the equity method of accounting. Okay, so I can see a couple of questions coming up. Tambeshwari is asking, sir, pre-acquisition dividend is given, what to do? You'll do exactly what we have seen. Okay, nothing beyond that. And I can understand some of your queries. So let me tell you one thing. Let me just help you understand this equity method of accounting. Okay. See, some of your points appear to be a confusion. Why? Because I think you're just trying to relate this method with the line by line addition. So let's suppose H limited and S limited were there. Okay, so let's suppose when we had these two companies. Now, in this case, when you had these two companies, so what did you do? You were doing line by line addition. Correct? Yeah. This was holding and this was subsidiary. Okay. Now, in this case, whenever there was any distribution of dividend, etc., you used to look at certain points. Yeah. Now, please understand holding and subsidiary, the moment you have this relationship, what do you follow? Line by line addition. Okay. But in the given scenario, when we have A limited and B limited, wherein B limited is an associate, for this consolidation, A limited will not follow line by line addition. Okay, so that appears to be a point of confusion. So this will not be followed. Okay, so please don't think we'll follow the same approach. In this case, what is required to be done? It is very, very simple. A limited in its CFS. So I'm talking about CFS. Will simply record one line item. What is that? Investment in B Limited. Investment in B Limited. So whatever is that amount. And any corresponding goodwill that is there, which is in which is a part of this investment. So that needs to be shown separately. So that's why you can say this investment in B Limited will have two parts. One that will be of goodwill or capital reserve, whatever be the case. And the second part will be that of net assets. Of course, on a proportionate basis, right? So these two in a combined manner will be the cost of investment, or you can say the investment. Yeah. So this is the only thing you are required to take to the consolidated financial statements. Okay. Now, if let's suppose a dividend is getting distributed, so that is reducing the net assets. So all of those things, yeah, we have looked at. And further, your another point of confusion has been around the distribution of dividend. Okay, so if you go back to AS21, there was a similar example. Okay, so if you just go back, maybe to after the session, you can go back. There was a similar example wherein A acquired B and there was a distribution of dividend. So that is again we looked at. So in this case, and similar to what we discussed over there, what do we have? A dividend has been paid. So what is going to be the impact of the dividend? So that will reduce the net assets. Now, when you talk about recording of that dividend in the books of A Limited, so A has already recorded that. Why? Because it's been distributed, received by A, so that is already recorded. So we don't need to record it again. Understood? Yeah. Currently, what is it that we are looking at? We are only looking at this part, which is in relation to CFS. Why? Because recording of dividend by B Limited to A Limited has already taken place. Where? In the standalone financial statements of A Limited. Okay, so that has already taken place. And where will it go? It will go to P&L of A Limited. So it's already there. Now, do we need to show that? No, because it's already captured there. You don't need to get into that. Understood? Clear on this? Yeah, clear on this? Okay, so then I can see some of your queries. I'm just hoping you're through with this now. Yeah. Okay, so then I think Sai has given one calculation. Here we can calculate the profit less dividend. So exactly this is what we have done, Sai. Huh? Yeah, so that's one and the same thing. Huh? So there could be various ways to present it. So it's up to you, whichever way you want to present. Okay, clear? I'm hoping Dinesh, you're clear on this. Yeah, please confirm. See, one method that you have seen for AS21 doesn't mean you will keep applying it everywhere. Huh? That's why we have discussed this, and that's why we are taking up these examples. Okay. Yeah. So that confusion you should not have. So forget about this method now. Forget about this method. Why? Because it's done. We have talked about subsidiaries. We have looked at them. We have done that consolidation. Okay. So that methodology is gone. Forget about it. Yeah. So line by line addition is not something that will apply universally. Okay. To each and every type of transaction. No. Forget about it. Done. Dusted. Fine. Sign clear? Yeah. Everyone clear? Quickly, please confirm, then we'll move further. Okay, so Dinesh is clear. Very good. Sai is also clear. All right, so let's move further. Okay, so Malu is also clear. Tambeshri is saying both method are different. Yes, of course. And that is quite visible, isn't it? So line by line addition method was quite different from what you have under equity method of accounting. Yeah, significantly different. In case of line by line, will you only pick up this line item? No, you'll pick up all the assets, all the liabilities. Okay, so let's look at this example. Case 1. A Limited holds 22% shares of B Limited on 1st April of the year, and following are the relevant information as available on the date. Okay, what is that information available? Cost of investment 33,000 and total equity on the date of acquisition 2 lakh. So now in this case, what will you do? You will do equity method of accounting, correct? Now, what is the purchase consideration? 33,000. Against this purchase consideration, the proportionate share of net assets is what? 44,000. So what do you get? What do you get? Goodwill or capital reserve? Tell me, what do you get? Goodwill or capital reserve? Capital reserve, 11,000. Correct? Yeah, Ragni, you may revisit this. Now, Dinesh has a question. So Dinesh is asking, sir, how do we identify what is going to be the appropriate method for the question? See, what is going to be the appropriate method of the question is quite a difficult question, isn't it? So I think you'll have to understand the question first. As of now, as I told you, you are unnecessarily creating a confusion for yourself. And what is that? You are just trying to mug up the things. Or maybe you're just trying to apply the same method to each and every question. So let's suppose you are given a question wherein you are required to prepare financial statements. Let's suppose you get a question wherein you are required to do sort of amalgamation accounting. Okay. Or maybe there's a question wherein the accounting requirement of AS9 is something you have to comment on. So in all of these questions, you tell me, how will you decide as to which method or what methodology you'll use? How is your answer going to change? That will again be dependent on the requirement of the question. Yes or no? Yeah. So that's why every time you'll have to understand the requirement. Currently, this confusion is there. Why? Because you are not through with this topic. So once you are through with this, once you are through with various other topics, and when you also practice a lot of questions, automatically you'll get the confidence. Okay. So please forget about it. That how will you understand? Question will of course tell you, but you'll have to understand the question, and for which you need to have the knowledge of the concept. Okay. Once you have that, you will also be able to do that. Don't worry. Okay, Dinesh, clear. Abhishek is saying percentage of holding is less than 50 and greater than 20. No, so I won't say that you apply equity method. Every time you'll have to assess about the type of investment it is. Okay, whether it is subsidiary or an associate, something that we have just discussed and we are discussing now. These are not the only two types of relationships. Other relationships are also possible, and we'll talk about those relationships as we move further. Okay, so we are not yet done. See, this consolidation topic is quite comprehensive. Consolidation is not limited to holding and subsidiary. At the same time, this is also not limited to subsidiary and associate. Joint ventures will also come. So let's get through with each and everything. What I'll do is, once we are through with everything, I'll just summarize this for you. Okay. So that you can just understand the difference between all of them. As of now, please don't try to create situations for yourself. I'll try to do that and help you understand that. Okay. Yeah. As of now, please remember that we are talking about associates for some time. Huh? Otherwise, what you are doing is you are just digressing it, and we are not able to concentrate on the topic right now. Okay. Yeah. So please stay in the topic right now. Okay. Bhavna is asking, sir, in this case, one difference goodwill होना चाहिए ना, capital reserve क्यों आ रहा है? Because capital reserve should be there. Yeah. So why do you think there should be goodwill? So let's suppose if you are paying purchase consideration in excess, that is when you get goodwill. But if your purchase consideration is lower as compared to the net assets, then tell me, it should be a goodwill or capital reserve? Bhavna, tell me. If your purchase consideration is lower, then what do you get? Goodwill or capital reserve? Tell me, Bhavna, quickly. Capital reserve. So in this question, your purchase consideration is 33,000. Okay. And the proportionate share of net assets is 44,000. So you tell me, what should we get? Clear? Yeah. Okay. So now in this case, let's understand how do you present it? How do you present it? So here again, you'll have to present this in the consolidated financial statements. To begin with, you will have share of net assets, 44,000 plus capital reserve. Now, because capital reserve is going to be negative figure, so that's why net amount, what is going to be that? Cost of investment. Okay. Eventually, you have to reach cost of investment. Yeah. To be shown in the consolidated financial statements. All right. Yeah. Okay. So let's look at another example. A Limited holds 22% shares of B Limited on 1st April of the year. And you are also given some information on the date. What is that? Cost of investment, purchase consideration is 55,000. Total equity on the date of acquisition is 2 lakhs. So tell me, what should we get here? In this example, what should we get? Goodwill or capital reserve? Over to you, quickly. Yeah, so in this example, what should we get? I think it's fairly simple. Huh? Hopefully, you understand this now. Yeah, so I think Tanu, Abhishek, Balesh, Manvi, Malu, everybody is getting goodwill. Yeah. Okay. And how do you present this? Here again, cost of investment is what you need to present. Cost of investment is what you need to present. Now, can you see the difference between these two presentations? One is this, other one is this. Now, here again, what is your cost of investment? Tell me, what is your cost of investment? Quickly, in this case, what is your cost of investment? 55,000. Yes or no? So this 55,000 you need to just break. So in a way, you can say the split of cost is required to be shown. So what is your split of cost? One is the share of net assets. Second is the amount of goodwill. So a sum total of these two is what you get in case of cost of investment. Okay. Yeah. Clear on this? Everyone clear on this? Yeah. Clear? All right. So now, okay. So Preeti is asking, capital reserve is deducted and goodwill is added. Yes. That's what you'll do. Tambeshwari is saying, in this case, we have not taken the reserve. Yeah, because there was no reserve. There was goodwill. So whenever you will have reserve, you will show that as capital reserve. Whenever you will have goodwill, you will show that as goodwill. Yeah, that is again dependent on the thing that you are getting, whether you are getting goodwill or capital reserve. Yeah, so in both the cases, we were getting two different things. One was goodwill and second was capital reserve. Okay, clear? Yeah. All right. So now, moving further, we'll talk about step acquisition. Step acquisition is what? Wherein you are getting significant influence on a step by step basis. So let's understand that with the help of this example. Okay, so this example, let's look at. Now, please remember that conceptually, the accounting requirement is going to be same. So that is not going to change. Riddhi is asking, sir, why do we reduce the capital reserve? Because that's how you compute the capital reserve, isn't it? So if you don't reduce it, so what is going to happen? Your cost of investment will jump. But can you just increase the cost of investment? So let's suppose if you pay 100 to acquire something, okay, and the net assets that you are getting against this 100 is 120. Yeah. So can you just increase the cost of your investment from 100 to 120? Tell me, Riddhi, can you do that? Can you increase the cost of your investment from 100 to 120? Tell me quickly. No. So that's why you don't do this, because your cost of investment will remain same. That will not change. Yeah, the only thing is that against this cost, you are getting something more. And that is why you call that as capital reserve. Understood? Understood? Yeah? Okay. Now, let's look at this case scenario. A Limited acquired 10% shares of B Limited. Now, please understand, only 10% of B Limited on 1st April. Now, on 1st April, can we say that B Limited is associate of A? Over to you. Can we say that B Limited is associate of A? Bhavna says no. Yeah? Nitin says no. Okay. Now, what is the relationship between A and B on 1st of April? On 1st of April, what would be the relationship between A and B? Quickly, over to you. What would be the relationship between A and B? Hardik says investor and investee, and I think same is the response from Kasak. Very good. So on 1st of April, there's only one relationship between these two companies. What is that? Investor, A is investor, B is investee. Now, there are so many responses wherein you are saying it's minority interest. We don't know whether that is minority or not. Okay? We don't know about minority. So let's not call this as minority. And anyways, this term minority is used in the context of AS21. So we should not do that. Okay. Idea is to understand the relationship between these two. That is very simple. One is investor, second is investing. Okay. Now, on 1st of October, A Limited acquired 15% additional shares. So 10% were already there. Now 15% additionally have been acquired. So what is going to be the total shareholding by A Limited and B Limited on 1st of October? 25%. Now on 1st of October, what is going to happen? This investor will start calling this investee B Limited as an associate. On which date? On 1st of April or 1st of October? On 1st of October. Correct? Yeah. So that's what Hardik says. Yeah. So now on 1st of October, relationship of investor and associate is established. Now in this case, this acquisition of interest in the associate is not done in one go. So this has been done on a step-by-step basis. Means first of all, 10% shares were acquired, then another 15 were acquired. Yeah. This is what you call as step acquisition. Means acquisition of shares on a step-by-step basis. Understood? Understood the meaning of step acquisition? Okay, now We are also given some additional information. So it says when these 10% shares were acquired, 1 lakh was paid. And when these 15% shares were acquired, 1,45,000 was paid. Okay. So all in all, what is the amount which has been paid to acquire 25%? Tell me, what is the total amount paid? Larry says 2,45,000. Yes? Great. Now, as against 2,45,000, if you look at the net assets of B Limited, so it was 8,50,000 on 1st April and 10 lakhs on 1st October. Means the net assets of B Limited on two dates are also given to us. Okay. Yeah. So now in this case, let's understand what do we need to do. On 1st April, when 1 lakh was paid, then the proportionate net assets were 85,000. So what will you have? Goodwill amounting to 15,000 on that date. But is this required to be recorded on 1st April? No, this is not required to be recorded on 1st April. So this calculation we are just doing. Okay. Now, on 1st October, when this 1,45,000 was paid, what were the net assets? 1,50,000. Yeah. So by paying 1,45,000, net assets worth of 1,50,000 were acquired. Correct. So therefore, in respect of 15%, what do we have? Goodwill or capital reserve? In respect of this 15%, what do we have? Goodwill or capital reserve? Capital reserve, right? Capital reserve of 5%. Okay. Now, when you record this, so what will you do? You will look at both. Means from the first acquisition, whether there was any goodwill or capital reserve, and from the second acquisition, whether there was any goodwill or capital reserve. And these two you will add. Okay, so goodwill is a positive number, capital reserve is a negative number. So that's why what will you have? Net goodwill of 10,000 in respect of this investment. Net goodwill of 10,000 in respect of this investment. Understood? Understood? Yeah. Okay. No sign. So Sai is asking that in this stepwise acquisition for the subsequent transactions, instead of making combined amount, if we do as individual transaction, then the result differs. Can we do the combined calculation? Then either, see, Sai, please understand, something that we have just discussed, that's the methodology you need to follow. Yeah. So, see, this is the biggest problem, I would say. Every time, whenever we are trying to do something, you are looking for alternatives. Okay. Please try to understand the methodology which is there, the methodology which accounting standard has suggested. So, if you don't follow that, obviously, what may happen is you may get different answers. But why do you want to get on to that? Because this is the methodology you need to consider. Understood? Everyone clear? Yeah, so every time, please don't look for the alternatives. Huh? So if there is a methodology which is given by the standard, that is something you need to follow. Fine? Yeah? Okay, so now, Kasak has also got one question. Kasak is saying, sir, please clarify that the assets are not taken on timely basis, means for 6 months. Yes. You are correct. Now, there is a reason behind that. What is the reason? This calculation of goodwill or capital reserve should not have been done at the first instance. Okay. Now, for this, you need to understand the consolidation requirements. If let's suppose there are two companies, A Limited and B Limited, wherein A Limited acquires 10% shares of B Limited. So in this case, do you think A Limited will be required to prepare CFS? Tell me, everyone. If A Limited holds 10% shares of B Limited, so do you think A Limited will be required to prepare CFS? Pranav says no, because A is not a holding company. But we discussed that consolidation is not only mandatory for holding, that is also mandatory in case the investee is associate. Yeah. So please don't use this term holding. Yes or no? Yeah. But one thing is for sure that consolidation will not be required in this scenario. Yes or no? Correct? So that means at this point of time, CFS is not required. Correct? Yeah. Now, let's suppose after some time, A Limited acquires some more shares of B Limited, and now total shares of A Limited held in B Limited are 25%. So now tell me, now will A Limited be required to prepare CFS? Now will A Limited be required to prepare CFS? Larry says yes. What about others? Nitin, Anil, Bhumika, they are saying yes. Kasak says yes. Okay, so now tell me one thing. When you prepare CFS, if let's suppose you are preparing CFS, so when do you start the consolidation? You will start the consolidation when the interest in associate is acquired. Yes or no? Yeah. So there are two dates. 1st April, 1st October, and this is 31st March. Your consolidation will not start from this date. No. When does your consolidation start? Your consolidation starts from this date. But because you will have to consolidate, okay, so will you be only looking at 15% stake? Because this 15 has made this total 25? Or will you be considering 25% for consolidation? Tell me. Will you be considering 25% for consolidation? So Kasak says 25%, Preeti says 15%, Riddhi says 25%. Yeah. So now please remember your consolidation starts from this date, in which case you will not be limited to 15%. Why? Because through 15%, the company doesn't become associate. Similar to what we had in case of 10%. See, individually, if you look at 10% interest and 15% interest, they don't make it an associate. Yes or no? They will make an associate when this is on a combined basis becoming 25%. Yeah. So that's why when you will start consolidation from this date, what do you need to consider? This 25%. Okay. And for consideration of this 25%, there are 2 points of time when you'll have to do the calculation. What are those 2 points of time? One, that is on 1st of April, and second is on 1st of October. Okay, and that is something that you will carry forward. Understood? Understood? Yeah, clear on this now? Yeah, clear on this? Okay, everyone clear? Why is this approach required to be considered? And I'm just hoping that Sai, with this, you would have got some more clarity, yeah, as to why this approach is required to be considered. Okay, Hardik has a question now. Hardik is saying, sir, by chance the second acquisition was next year. Let's suppose if that moves on to the next year, then for this year, we'll make the investment account in the current year and AS23 in the next year. Yes. Yes, obviously. So that is something you'll have to follow. Okay, because you can't go back to your previous year because that is already done, for which you have not prepared the CFS. And I think with this, you will also get more clarity that where does this consolidation really starts. Kasak is saying it means April calculation is carried forward. No, April calculation is not carried forward. It's that on 1st October, you will do two calculations. One as on 1st October, one as on 1st April, and that is what you will carry forward starting from 1st October to the reporting date and the periods thereafter. Okay. Yeah, clear? Everyone clear? Okay, great. So now we can just look at one more example. I think we can just look at one question now. Okay, so let's look at this question. Question 2. Okay. A Limited acquired 40% shares in B Limited on 1st April X1 for rupees 2 lakhs. So now in this case, what is this 2 lakhs? What is this amount of 2 lakhs? What do you call this as? Quickly. What do you call this amount of 10 lakhs as? What do you call this amount of 10 lakhs as? Great. Tambeshwari says cost of acquisition, or you can say purchase consideration. Yeah, that's one and the same thing. Correct? Okay. Okay. Now, on the date of acquisition, B Limited had 1 lakh equity shares of rupees 10 each, fully paid up, accumulated profits of rupees 2 lakhs. Okay, on the date of acquisition, how is this information going to help us, which is given in respect of B Limited? What do you think? What is the purpose? How is this information going to help us? Quickly, over to you. Hardik says to calculate goodwill or capital reserve. Correct? Okay. This information is about the net assets of B Limited. Yeah. So therefore, goodwill or capital reserve that we calculate will be calculated based on this information. Okay. Now, during the year X1, X2 means after acquisition, during this financial year, B Limited suffered a loss of 10 lakhs. All right. So what is going to be the impact of this loss of 10 lakhs? What is going to be the impact of loss of this 10 lakhs? Over to you quickly. Very good. Hardik says subtract this from the cost of investment, or you can just simply say that this will reduce the net assets. This will reduce the net assets. Correct? That's what Vibor is saying. Okay. Now, During the year X2, X3, so after another year, there was a loss of 12 lakh 50,000. So once again, what is going to be the impact? Net assets will go down. Next year again, information is available X3, X4. But in this third year, means third year starting from the date of acquisition, what do you have? A loss of 5 lakh. Okay. So in the three following years, there are losses 10 lakhs, 12.5 lakhs, and 5 lakhs. All right. Show the extract of the consolidated balance sheet of A Limited on all the four dates recording the above events. Okay, so we are required to record these events. Yeah, so let's do that. So in a way, what is the question asking you? Question is asking you to prepare the consolidated balance sheet on four dates. What are those four dates? Date of acquisition, and the reporting year end. So three reporting years are given to us. So end of each year you need to show. Simple. Yeah, simple, easy to calculate. Yes or no? Yeah. So can you tell me the amount which A Limited will record on the date of acquisition? Okay, over to you. Then I'll move on to the next years. Over to you. Please don't look at the solution which is given. Just apply your thoughts and try to solve this. Yes, over to you. What is going to be the amount on the date of acquisition? How do you present it? Okay, Anjali has computed this. Anjali is saying there will be goodwill of 5,20,000. Okay, so Pranav is getting a goodwill of 4 lakh. All right. What about others? You may just only confirm the amounts you are getting on date of acquisition. Manvi is getting goodwill of 5,20,000 negative. Oh, sorry. So that was the hyphen you had. Okay, no worries. 5,20,000. I think same is the response from Tambeshwari, Ragini, Nitin, Abhishek. I think Hardik is also Hardik is shown the presentation, how you'll show this. Okay, Pranav has got the same answer now. Dilip has got the same answer. Okay. Yeah, so let's get on to this calculation plus also the presentation in respect of consolidated balance sheet. Yeah. Okay, now to begin with, what do we have? Equity shares plus reserves, that means the net assets. 12 lakhs. And the proportionate share of net assets is 4,80,000. What is the amount of purchase consideration? 10 lakhs. So that means amount paid is in excess. Great. Kasak has also showed the presentation. Very good. So amount showed paid is in excess. So if the amount is paid in excess, what do you get? Goodwill? Goodwill? Yeah. So that's why we have a goodwill. But this is only the calculation. This is not the presentation. Yes or no? Okay. So now let's move on to the presentation. If we have calculated goodwill, then I think presentation is going to be simple. In terms of presentation, what do we need? Only one thing. Only one thing. What is that? Cost of investment to be shown, and a split of cost of investment is required to be given. That's it. That's it. Okay. So now, cost of investment was what? 10 lakhs. Correct? And for this cost of investment, a split is required to be given. So what is going to be that split? Very simple. share of net assets and goodwill. Yes or no? Everyone clear on this presentation? So this is nothing new. Yes or no? Yeah. So this is not new. So this is what we have been doing in our previous questions also. Correct? Okay. Now, let's move on to end of reporting year 1. At the end of reporting year 1, there is a loss of 10 lakh. Correct? So it says B Limited suffered a loss of rupees 10 lakhs. So therefore, what will happen? Therefore, proportionate share of this loss will be passed on to A. Yes or no? Proportionate share of loss will be passed on to A. So what is going to be the proportionate share of this loss? Nitin says 4 lakhs. Yeah. Okay. So now this calculation that we had, okay, this sort of calculation. So we can just continue with this presentation. Okay. Now, as at 31st March X2, as at 31st March X2, if you look at the cost of investment, which had share of net assets as 4,80,000, goodwill as 5,20,000, sum total of which was 10 lakhs. Okay, so the same amount we are carrying. Now, from this cost of investment, or you can say to this cost of investment, proportionate share of net assets is required to be added. So every time when you do the equity method of accounting, what do? You will add the proportionate share of net assets. Yes or no? You'll add the proportionate share of net assets. But in this case, net assets have got reduced. Net assets have got reduced. So that's why instead of adding, you will reduce this by 4 lakhs. Instead of adding, you will reduce that by 4 lakhs. Correct? So if you reduce that by 4 lakhs, what is going to be the cost of investment? 6 lakhs. So the cost of investment will be 6 lakhs. So in totality, our cost of investment at the end of reporting year 1 should be what? 6 lakhs. Yes or no? That should be 6 lakhs. Yes or no? Quickly. Correct? Okay, now let's understand as to how do you present this cost of investment of 6 lakhs at the end of reporting year 1. Now you may be thinking, but sir, is this not the presentation? No, this was not the presentation. This was the calculation, because all in all, we knew that there is a cost of investment with which we have started 10 lakhs, from which 4 lakhs has been reduced. Now, if you present this in the consolidated balance sheet, so let's understand how do you present it. In the consolidated balance sheet, if you go back to the date of acquisition, so there were 2 items. In the consolidated balance sheet, as at the date of acquisition, there were 2 items. Yes or no? Share of net assets and goodwill. Sum total of which was 10 lakhs. Correct? Now, whenever you have this net assets addition or deletion, where do you adjust this first? To the net assets share. Okay, so this share of net assets, which was there as on 1st April X1, you will start with that, to which you will add any change in net assets. Now, in this case, change is negative, so that's why you will deduct. So what do you get? 80,000. So your share of net assets is what? It's reduced to 80,000 now at the end of first year. At the end of first year. Okay. But the amount of goodwill is intact. That is not changing. That is not changing. Okay. So therefore, your cost of investment comes out to 6 lakhs. Clear? Everyone clear on this presentation? Any questions on this? Quickly, huh? Everyone clear on this presentation? Any questions, any doubts if you have? Quickly, huh? All right. Yeah, clear? Very good. So Abhishek is clear. Nitin is also clear. Great. Okay, now at the end of second year, can you tell me the amount of loss? Because we understand at the second year, again, there was a loss. What was the amount of loss at the end of second year? 12 lakh 50,000. And proportionate share of this loss will again be taken up by whom? A Limited. So what is going to be the proportionate share of this loss? 40% of 12.5 lakhs. That is what? 5 lakhs. I think everyone has computed that. Yeah. Tanu, you may revisit your number. So that is 5 lakhs. Proportionate share of loss. That is what? 5 lakhs. Correct? Okay, now, in the same manner, like we did our calculation in the first year, we'll do the same calculation. Okay. So now, cost of investment with which we start our second year is 6 lakhs, from which this loss of 5 lakh has to be reduced. So at the end of second year, cost of investment should be 1 lakh. Okay, it should be reduced to 1 lakh. Now, to begin with, if you go to the consolidated balance sheet, in the consolidated balance sheet, what is the amount of share of net assets? That is 80,000. That is 80,000. You may say it's 480, but that's for the calculation purposes only. It's 80,000. Correct? From this 80,000, what do you need to reduce? 5 lakh. From this 80,000, what do you need to reduce? 5 lakh. So if you reduce 5 lakh, the net amount that you get is what? 4 lakh 20,000 negative. 4 lakh 20,000 negative. Now, this negative amount will have the impact of reducing the amount of goodwill. Now, what was the amount of goodwill at the beginning of second year? 5 lakh 20,000. Yes or no? From this 5 lakh 20,000, what will you do? You will reduce this 4 lakh 20,000. So therefore, what is the amount that you are going to get? 1 lakh. So this 1 lakh pertains to what? Only goodwill. This 1 lakh pertains to what? Only goodwill. So that's the cost of investment that we have at the end of second year. Okay. Yeah. Which should have been the final result. That is something we have already looked at in our calculation. Yeah. Everyone clear on this? At the end of second year, everyone clear as to how this amount will be presented in the consolidated balance sheet? Yeah. So the same way we have moved, same way we did in first year, we have moved in the second year. Everyone clear on this? Second year again. Tell me quickly, everyone clear on this? Around second year also? Quickly. Yeah. All right, great. So now, in the third year, once again, there was a loss. So can you tell me the amount of loss which was there in third year? In the third year, 5 lakh. Great. Preeti says it's 5 lakh. And what is going to be the proportionate share of this loss? 2 lakhs. Yeah. So Manvi says it's 2 lakhs. So 2 lakhs is the proportionate share of loss which will be passed on to the investor. That means A Limited. Okay. But there is a problem. What is the problem? Cost of investment of the investor, which is appearing in the books, is only for 1 lakh. Can you see this? Yeah. So it is only at 1 lakhs. So therefore, what will happen in this next year? We will start with the carrying amount of investment of 1 lakh, to which we will also allocate this loss of 2 lakh. But what do we need to do? Now we will have to restrict this loss, or you can say share in net assets, to the amount of cost of investment. Means cost of investment you will not make as zero. Okay, you will not make it zero. So the standard says under equity method, investors share of losses of an associate, if that equals or exceeds the carrying amount of the investment, then what will happen? Investor will discontinue recognizing its share of further losses, and the investment is reported at nil value. Okay, this is quite similar to what we had in case of minority interest. Remember, when there was minority interest, and when the minority interest became nil, so were you passing on further losses to that minority interest? Remember, there was an example in CFS under AS 21 that we discussed. Remember that? Yeah. So it is quite similar to that concept. Okay. It is quite similar to that concept. Understood? Yeah. Okay. So now let's go back to the calculation. Okay. So we are not yet done. So in our calculation, what is it that you start with? 1 lakh. From this 1 lakh, what do you need to reduce now? 2 lakh, but 2 lakh will be capped to 1 lakh. So that's why at the end of third year, carrying amount of investment should become nil. Okay, so that should be your presentation. Now, let's begin with our presentation. Okay, let's begin with our presentation. So at the beginning of the year, sorry, at the beginning of third year, I should say, what was the amount of investment in the consolidated balance sheet? Tell me quickly. At the beginning of third year, what was the amount of investment in the consolidated balance sheet? Over to you. What was the amount of investment in the consolidated balance sheet? Quickly, huh? Tambeshwari says 1 lakh. That's 1 lakh. Yes or no? That's 1 lakh. Okay, now we will start with this. Yeah, so we'll start with this 1 lakh. And this 1 lakh you will reduce from the cost of investment. So therefore, what will you have? You will have investment in B Limited appearing at nil value. Appearing at nil value. So I think in the solution, this deletion has not been shown as a separate line item, but you can just always present it the way we just discussed. Okay. Yeah, because eventually in the consolidated balance sheet, you need to reach to nil value. Okay, so that is where you need to reach. Clear on this? Everyone clear on this? Quickly. Okay, so I can see some queries coming up. Hardik is saying, sir, in the last 3 years, there can be alternate that as there is a loss of investment of associate, the amount can be transferred to the holding company, and proportionately afterwards in the profit associate will see. Once again, I can see the similar sort of problem. Huh? Okay, and let me just help you. I think for some reason, you are not able to come out of this confusion. But let me just help you. Okay, now what is the confusion? So our example was that of A Limited and B Limited. Correct? So this is the example that we just discussed. Yes or no? Wherein A Limited held 40%. Yeah? Now, every time we are doing an accounting, so you are also trying to get into the accounting which we had in case of holding and subsidiary. So let's suppose there is a holding company as well, H Limited, which held 60% shares in B. Okay. Now, will H Limited prepare its CFS? Yes. Will A Limited prepare its CFS? Yes. Both of them will prepare CFS. When H Limited will prepare CFS, in its CFS, H will have one item, minority interest. And who is going to be that minority interest? That will be A Limited. Okay. If let's suppose H Limited will record minority interest, so minority will keep picking up the proportionate share of net assets, and up to a stage when the amount of minority interest will become zero. So what will happen? This minority, so this is let's suppose year end 1, this is year end 2, this is year end 3. So sometime on this date, this minority will stop taking up any interest. Why? Because these are all losses. So minority will not absorb that. So they will get passed on to holding only starting from this date. Yes or no? So that's the accounting you'll do. Yeah. So is this accounting requirement going to change? No. But where is this accounting required to be done? That will be in the CFS of H Limited. Currently, we are looking at CFS of A Limited. Now, this CFS of A Limited is completely independent of the CFS of H Limited. As of now, my only suggestion is let's not get into this CFS. Okay? Because more and more you'll think about this CFS now. What will happen? Your questions, your doubts will keep increasing. I can understand you are just trying to correlate the things, but that is not required. Okay. But to answer your question, Hardik, as of now, if you are talking about this accounting requirement between A and B, wherein A stopped taking any loss share. So this is year 1, this is year 2, and this is year 3. Okay. So at this point of time, A Limited stopped taking any interest. Why? Because its cost has become zero. Yeah. So this is no different from what we are watching here or what is required to be done over there. But please understand these two are completely different accounting requirements done by two different companies, wherein the approach for consolidation is also completely different. Understood? Clear? Yeah. So Bhavna is saying, sir, up to 1 lakh, it will be borne by A Limited and remaining 1 lakh will be transferred to H Limited. So we don't know. We don't know. See, because when you are talking about A Limited, and at the same time, if you are talking about H Limited, then I think you should not use the term A Limited. You should use the term minority interest. So that you are clear that now you are talking about consolidation requirements under AS 21. Yes or no? Because consolidation requirements are two different. One that is of AS 23 and second is of AS 21. And there are two different sets which are being prepared. One by H and one by A. Okay, so I would suggest use two different terms. Start calling it as minority. Okay, understood? Yeah, Bhavna, clear on this? Anyone else? Any more questions? Okay, Kasak is saying, sir, let's suppose there is profit in the fourth year and subsequent years, then it should be taken to the losses first and then after. Yes, so the same approach you'll follow. Sai is asking, due to loss, if it is not disclosed in the financials, is it to be given in the notes to the audit report? No, so I don't think there is nothing as regards the audit report because that is more of an audit matter. Okay. But yes, if there is any such loss share, for example, in third year, there's a loss share of 2 lakhs, but the parent has only absorbed 1 lakh. So in the notes to accounts, in the financial statements, A Limited will give this disclosure, but that disclosure will be given in the notes to accounts to the consolidated financial statements of A Limited. Understood? Yeah. There's nothing as regards audit report because that is an audit matter. So that you should park for your audit session, not right now. Yeah. Because there again, the consideration of auditor will have to be looked at. Company has got nothing to do with that. Company will have to only look at the financial statements. Okay. Yeah. So Bhavna is clear on this. What about others? Quickly, huh? Okay. So Preeti is also clear. Kasak is also clear. Great. So I think if you are clear, then we can just take a break now. And after the break, what we will do is we'll just move on to our next topic, AS27. Okay. So after the break, we'll move on to our next topic. So we are not going to discontinue on this consolidation. Please remember, so all of this will be consolidation, but the standard is going to change. Okay. Yeah. So let's continue after the break. Anil has one question. Yes, Anil, please tell me what is your query? Yes, Anil. Of course, we can discuss the questions and then we can take the break. No worries. Tell me quickly. Okay, so Anil is asking, sir, we are going to nullify the investment value in cases in cases in case there's a loss. See, I would say yes, of course, by nullifying, you can say the cost of investment will go down. Yes, to a certain extent, that is correct. You can say that. Yeah, so if you make this statement, that will not be inappropriate. So you can say that. Yes. Okay. Malu is saying, sir, in case loss is carry forward to the next year, see, that carry forward concept is there in income tax. Okay. That is not there in books of accounts. So whatever is the loss that's been recorded to the P&L and that's gone. Yeah. So there's no such carry forward under income, under accounting requirement. Carry forward could be in the form of reserves. So you can say your reserves have turned negative. So that is what you are moving to the next year. So that's how you can consider to be a kind of carry forward. Yeah, but otherwise this term carry forward you use under income tax for losses. Stambeshwari is asking separate financial statements. What is required? In the separate financial statements, of course, impairment could be one of the things which you need to look at in respect of this type of investment, wherein the investee is running into losses. Hardik is asking, can you please explain this scenario? Third, so I think maybe if you have any specific question on that, we can discuss that, Hardik. Yeah, otherwise we'll have to just keep discussing each and every case scenario. Maybe you can just go through that. Any questions, doubts you'll have, we can discuss that. And I also understand you shared one question, but you didn't share the solution for that. I went through your question also, but in that document, the solution is missing. So it will be helpful if you can share the solution also so that I can understand as to where is it that you are going wrong. Yeah. Yeah. So you can share that maybe towards the end of session or any time. You may just let me know. Okay. So I'll have to just go through the solution as to what is bothering you over there. Yeah. But the question I've looked at. Okay. All right. So Anil has one more question. Anil is saying, sir, the carrying amount of investment is zero at the end of fourth year. No, at the end of third year. And in case there are profits after that, do we consider? Yes, of course. Of course, you'll consider. Then you will just keep taking them to the share of the net assets. Yeah, of course, you'll do that. Okay. All right. I think we can take a break now. Yeah. Okay. So, Nisarg, we can take the break. Nisarg. Nisar, can we continue? Nisar, Nisarg, Nisarg, are you there? I think we can continue. Yeah. All right. So now moving further on to the next topic, and that is about joint ventures. Okay. So in respect of joint ventures, let's try to understand as to what is a joint venture and under what situation the investee. Now there again, we are going to talk about investor and investee. Under what situations the investee will be considered to be a joint venture, because depending on the type of joint venture it is, once again will have the requirement of consolidation, means will have the requirement to prepare consolidated financial statements. Okay, so now the first step should be to consider under what situation an investee will be considered as a joint venture. Yeah, so let's talk about it. AS 27 requires certain conditions to be fulfilled, yeah, by the investee in respect of the investment. Now what are those conditions? So it says if there are two or more parties, okay, so that is one, and they have a contract. Now what do you mean by contract? Means they have an understanding, they have an agreement, or there is a shared understanding in respect of an investment through which these two or more parties will have joint control in the investee. So what is the third condition? Joint control. Okay, now the moment we have all these four conditions, sorry, all these conditions fulfilled, so what do we say? That the investee will be a joint venture. Yeah, so let's try to understand this with the help of some examples. Now there are two companies A and B. Let's suppose these two companies have come together, okay, and they have created a new company, or you can say they have set up a new company. What is the name of this new company? Let's suppose AB Limited. Now please remember, A Limited is not going to end its business. It's not closing its business. A Limited will continue. Similarly, B Limited will continue. Or maybe that it's not A Limited only A, an individual. Or maybe it's only B, an individual. So it's not necessary that it has to be A Limited or B Limited. Yeah, we are keeping it as A Limited and B Limited. Now, let's try to apply all of these conditions. So what was the first condition? There should be two or more parties. Okay. Now, what do you mean by these parties? Means that two or more investors. So we are talking about investors here. So do we have two investors? Yes. A and B. Let's suppose their percentage shareholding in AB is 50 each. So this holds 50%, this holds 50%. Yeah. Now these two investors have an agreement. So they have an understanding amongst themselves. So this agreement is not with AB Limited. No, the agreement is between A and B, between the investors. So that's the understanding between these two investors. Now, what is the understanding? That both A and B will control AB Limited. Now, what do you mean by this control, which both of them will exercise? Because you may be thinking that control is one thing that we have already discussed in case of a subsidiary. Yeah, so in case of a subsidiary, we understood that control. Now, in case of a subsidiary, the control that we talked about was unilateral control. Unilateral control means in that case, only A Limited was exercising control over BB, or only B Limited was exercising control over AB Limited. Means there was one person who was having the final say in the decision making, or one investor who was having final say in the decision making. But now this situation is different from that. So how is it different? Now there are two parties. Now there are two parties, A and B. And in this case, tomorrow, if any decision in relation to AB Limited is required to be taken, so what is going to happen? If let's suppose A doesn't like that matter, so can that matter move forward? No. If let's suppose B decides not to move that forward, can it be done? Yes. Which means till the time, which means till the time both A and B will not have unanimous consent. Unanimous consent means consent of each party. Okay, and you may not make a note of this. Till the time both of them, A and B, do not have unanimous consent. Unanimous consent means consent should be there of each party. The matter will not move forward. The decision cannot be taken. This is what you call as joint control. Okay, so this is what you call as joint control. So now we are no longer talking about control by one party. We are talking about joint control, means which is controlled by these investors, A as well as B. And the moment we have these three conditions fulfilled, then what will you have? Then in such a case, this company AB Limited will be considered as a joint venture. This will be called as a joint venture. Understood? Understood? Everyone clear on this? What is the meaning of a joint venture? This is very, very important. Yeah. And under what situation a company can be considered to be a joint venture? Yes. Any questions, any doubts if you have? So in this case, AB Limited will be considered to be a joint venture. Yes. Any questions if you have? Tambeshwari is saying decision point again. Yes. So the decision point is that in respect of AB, if any decision is required to be taken, then it has to be done by A and B on a collective basis, on a mutual basis. Means both of them should give their consent in relation to that matter. If they do not give their consent, matter will not move forward. It should not happen that A is giving the consent and matter is moving forward, or only B is giving the consent and the matter is moving forward. No. Till the time both of them do not agree, the matter cannot move forward. Decision cannot be taken. That is what you call as joint control. Joint control will arise when the unanimous consent is required. And this should be the understanding between these two investors. This should be the agreement between these two investors. That is why we are saying there has to be a contract. By contract means joint understanding, common understanding, an agreement. Okay? Clear? Yeah? Any questions if you have on this? Quickly, any questions if you have on this? Any questions, any doubts? No? Everyone clear? Yeah? So what's the meaning of a joint venture? How do you get a joint venture? Yeah? Okay, so then I can see Anil has a question. Anil is asking, just a minute. So agreement can be overriding, right? Like A can dominate B through agreement. No, the moment you say that it is overriding means A can bypass B, then the unanimous consent will go away. And the moment you have that, what will happen? Joint control will not be there. And if the joint control is not there, then it will not be called as a joint venture. Understood? So for a joint venture to be in place, joint control has to be there. Yeah. Kasak is asking, sir, is it necessary that both of them have 50% each? No, it's not necessary. It may happen that both of them have, say, 55 and 45%. Or it could be 60-40, or it could be 30-70. Yeah, so the percentage shareholding is not necessarily required to be equal. Why? Because the equal rights of investors are not established through this percentage shareholding. That is getting established through this contract. That is through this contract. Why? Because through this contract, they are saying that we will have equal rights in respect of decision making. Yeah. Anil is saying, so everything has to be equal in agreement. See, not everything. Decision making is something over which they need to have equal rights. Because when you say everything, their profit sharing could be different. Yeah, their sharing towards assets could be different. Their sharing towards liabilities could be different. Okay. So that can always be different. Like we just discussed, their profit sharing could be different. But what has to be same, that is what you call as consent, the right to take the decision. That has to be equal. Only and only when right to take the decision is equal, that is when you will call it as JV. Otherwise not. Otherwise that will not be called as a JV. Okay. Clear? Anil, clear on this? Yeah. For this JV to be called, joint control has to be there. Fine. Everyone clear? Yeah. Now this is the most important point in case of a joint venture. Joint control. So every time you will analyze any investment, what do you need? You need to check whether joint control is there or not. The moment there is a joint control, so what would you call this investee as? This investee will be called as a joint venture. Yeah. And in this case, A and B could be called as investors or venturers. You may call them as investors or venturers. Okay. Yeah. We are calling A and B as venturers, not as joint ventures. Because what is a joint venture? That is AB Limited. Yeah. So the investors are called venturers, not joint venturers. Clear on this? Yeah. So these terms become important. Okay. Now, here again, here again, because there is a joint control. So what will happen? Similar to what we have discussed in case of holding and subsidiary, in case of associate companies, here again, the requirement to consolidation gets triggered. And who will be required to prepare CFS? AB Limited? No. A Limited. As well as B Limited. Okay. And when they do this, when they do this, when they prepare the CFS, so what will A Limited do? A Limited will consolidate A Limited and AB Limited. Similarly, B Limited will consolidate B Limited and AB Limited. So A Limited will not consolidate three companies, A, B, and AB Limited. No. B Limited will not consolidate three companies, A Limited, B Limited, and AB Limited. No. They will consolidate only the investee which they have, over which they have joint control. Okay? Yeah? Clear? So now, here again, the requirement to prepare CFS arises. Yeah, here again, the requirement to prepare CFS arises. But in this case, the method to prepare CFS will not be of line by line addition, will not be of equity method. This method will be different from both those methods. Okay. So therefore, depending on the type of investee it is, whether it is subsidiary, associate, or joint venture, the consolidation requirement will change. Yeah. But please remember, now I think you can also, to a certain extent, summarize this. That consolidation requirement will only arise in three situations. What are those three situations? One, that is of subsidiary. Second, that is of associate. And third, that is of joint venture. Okay, so this is the last one. So you should not think that, oh, there are a lot of other types of consolidations which are going to come. No, this is the third one and the last. Understood? Yeah. So these are the three scenarios in which CFS will be prepared. Now, an investor may have either of them or may have all of them. It doesn't matter. It doesn't matter. Clear? Yeah. Okay, so now we can look at some examples, some very small examples. Okay, so let's look at this example one. IDBI gave loan to joint venture entity of L&T and Tentia Corporation Construction. Okay, so there is a JV of two companies. So who are the two investors? L&T and Tentia. So these are the two investors. And they have a JV company. What is the JV company? Its name is not given. It's a JV. Correct? Now, IDBI gave a loan to this JV. They signed an agreement according to which, now who signed the agreement? Venturers. L&T and Tentia signed an agreement according to which IDBI will be informed for all the important decisions in respect of JV entity. Okay, so let me just again put this on a chart. Now, this is again very important. Okay, because once again, over here, there could be a lot of confusion. So we have a situation now wherein there are two companies, L&T, and let me just call it as TC. So these are two companies and they have created a JV. So they already have a JV. Now, do L&T and TC have joint control over JV? The answer is yes. Why? Because the moment you say it's a JV, it means these two have joint control. Okay. Now a third party is also coming into picture. IDBI. Okay. So third party is also coming into picture. Now the understanding is that L&T and TC will inform IDBI. So they will inform IDBI in respect of all the important decisions which are going to be taken for this JV. Means for this JV, any important decision that will be taken. So what will happen? IDBI will have to be informed about it. IDBI will have to be informed about it. So in this case, now the question arises that should we treat IDBI also as one of the venturer? And thereby, can we say that now it's not only L&T and TC, but all these three parties have joint control over this JV because of this understanding, because of this contract. Okay, so there's a contract which these three parties have signed. Yeah, so that's the question. So what do you think? In this case, what do you think? What do you think? With the reason, please. So everyone is saying no. Can you tell me the reason? Can you tell me the reason why no? Sainath says no. Dinesh says no. Abhishek is saying no. Anil is saying JV, sir. JV means what? What is this reason JV? Sainath says because it is only the provider of credit. Okay, so now let's try to understand this. Every time we need to evaluate whether the party has control over another company or not. What is the criteria? What is the criteria? You will always go and check whether there is joint control or not. Okay. Now in this case, for this joint control, what do you need? Tomorrow, if any decision is required to be taken, so what will happen? Consent of all three should be required. If that is the case, then we'll say yes, L&T has joint control, TC has joint control, and IDBI has joint control. But if you look at the fact pattern, what does it say? It says that any important matter over which a decision will be taken. So what will L&T and TC do? They will only inform IDBI. Are they reaching out to IDBI for taking their consent? Tell me. Do they need to reach out to IDBI for taking their consent? No. They will only inform them that this is what we are doing or this is what we are planning to do. But they will not reach out to them for their consent. Okay, consent is not required. So the moment we say consent is not required, what will happen? Joint control will not be there. And if the joint control is not established, then what will happen? This will not become a JV. Clear on this? Clear on this? The moment you say joint control is not there, it will not be JV. So of course you can say IDBI is provider of finance or a lot of things, but that is not the way through which you will evaluate. What are the ways through which you will evaluate? There is only one way. And what is that? To look at these conditions. And please remember, all these conditions have to be fulfilled. Now, in that example, do we have two or more parties? Do we have two or more parties? The answer is yes. Can we say there is a contract between them? The answer is yes. So, two conditions are fulfilled. Third condition, do they have joint control over JV? No. And the moment this third condition is not fulfilled or either of them is not fulfilled, what will happen? It will not remain JV anymore. Yes or no? Yes or no? Clear? Yeah? Okay, so now another example. So I'm just moving on to the next example. X Limited invested rupees 200 crore as initial capital along with Y Limited and Z Limited in GFH Limited. Okay, so there are three companies: X Limited, Y Limited, Z Limited. Okay, X Limited has invested in GFH. Okay, so that means all of them have invested. Amount of X is given to us. The purpose of X Limited making this investment in GFH is to grow the business of GFH along with other investors. Means along with Y and Z. All the investors have the right to attend meetings and to make the decisions with respect to business of GFH. All the investors are actively involved in the business of GFH and they have a return in the they have a share in the returns of GFH. So in this case, will you say that GFH is a JV of X, Y, and Z? Tell me. Will you call this as a JV of X, Y, and Z? Kasak says yes. Why? Because all the three conditions are fulfilled. Do we have two or more? Yes. Is there any agreement? Yes. And is there a joint control? Yes. So all the three conditions are fulfilled. Okay. Another example. Huh? Mr. A. So we have Mr. A. Then we have B and company. So it seems to be a firm. And then we have C Limited. So one is an individual, second is a firm, third is a company. They enter into a JV where according to the agreement, all the policy making decisions on financial and operating activities will be taken in regular meeting attended by them or their representatives. Implementation and execution of these policies will be the responsibility of Mr. A. So there is a JV they have created. So what does it mean? It means that in respect of any matters, who will take the decision? It will be collectively by A, B and company, C Limited. Okay. But Mr. A has been assigned some additional responsibility. See, as regards the decision making, the right is equal. Okay. So it has got joint control. It has got joint control. It has got joint control. Now, what are the additional responsibilities which have been assigned to Mr. A? That implementation of any policy, execution of the policy, who will supervise that? So Mr. A will supervise that. Okay. So you can say supervision responsibility is assigned to Mr. A. Now, can we say that because of this supervision responsibility which has been assigned to Mr. A, that's why it will not remain a JV anymore? Why? Because A will be involved in all of these tasks, all of these activities, wherein B and company C Limited will not be involved. Tell me, can we say that? Can we say that? Quickly, any thoughts? Hardik says no. Abhishek says no. And that's the correct understanding. See, in respect of the company, lot of activities are required to be performed. Yeah. Now it doesn't matter who is involved in performance of those activities, or it doesn't matter if only one of the venturer is taking care of all of those activities till the time this decision making is joint. Yeah, because that is more of a responsibility. You can say that is more of a managerial role which has been assigned to Mr. A, which he can do. But that doesn't give him additional powers in respect of decision making. Because the moment you'll say that Mr. A has got additional powers in respect of decision making as compared to B and company, as compared to C Limited, that is when you can say it's not a joint venture. But currently, these are not additional parts, these are additional responsibilities in respect of performance of certain activities, whereby this relationship of JV doesn't get disturbed. Okay, so it will continue to be called as a JV, as a joint venture. Okay, clear on this? Any questions, any doubts if you have? Over to you. Any questions, any doubts quickly? Any questions, any doubts? No? All right, so now moving further. Now, in respect of the JV, standard has given us three further types. Okay, so we are not going to discuss anything new. Why? Because we are still on JV, we are still on AS27. But now we need to move further. Why? Because now we also need to look at as to how consolidation will be done. Yes or no? So for consolidating a JV means for getting into the accounting requirements. So far, whatever we discussed, that was all assessment, whether an investee will become JV or not. Now, once you have done that, if you want to get into the accounting requirement, so what do you need? Standard says you need to assess. You need to assess whether that JV is a JCO, jointly controlled operation, or a JCA, jointly controlled assets, or a JCE, jointly controlled entities. Means three types of JVs are given to us. So every time there is a JV, what will you need to check? You will need to check whether it is a JCO. Sorry. You'll need to check whether it is a JCO or a JCA or a JCE. Why? Because depending on the type, its accounting will have to be looked at. And accounting requirement for all these three types is different. Understood? Yeah. But please remember one point. Whether we are talking about JCO or JCA or JCE, all of them are what? Tell me, all of them are what? Over to you quickly. All of them are what? Joint ventures. So that means whenever you will get into this assessment of JCO, JCA, or JCE, those three conditions must have been fulfilled already. What are those? Two or more investors should be there. Okay. Number two, there has to be a contract. Number three, there has to be joint control. Yeah, so please don't forget this point, because over this there could be a confusion. Yeah, so whenever you jump onto that, you need to take care of this. Okay. Yeah, so now we'll now start with this JCO. So let's try to understand this JCO, and what we will do is we'll look at one example. Through the example, we'll try to get some clarity around the JCO. Means, what is a JCO? What is your understanding around the JCO? That is something we'll discuss with the help of an example. Okay. Mr. A is a dealer in tiles and marbles. Mr. B is a dealer in various building material. And Mr. C is the promoter. So they enter into a JV business. Now, in this case, please understand, we are already told that they are entering into a JV business. So what does it mean? That the conditions for JV are fulfilled. Understood? Yeah. So we have a JV to look at. Yeah. Now, when they enter into a JV business, wherein any contract for construction received will be completed jointly. Say Mr. A will supply all tiles and marbles. Mr. B will supply other material for his godown. Mr. C will look after the completion of construction. Now, as per the contractual agreement, they will share their profit losses in a certain ratio. Now, what is that ratio? We don't know. And does it really matter to us? Tell me, does the profit sharing ratio matter to us? What do you think? No. So it doesn't matter to us. Yeah. Okay. Now, none of them are using separate staff or other resources for the JV business. Neither do they maintain separate account. Everything is recorded in their personal business only. Now, the venturers, we are not talking about JV. We are talking about venturers. They do not maintain separate books, but they record whatever portion which belongs to the JV business in their own books of accounts. Okay. Any transaction of JV recorded separately is only for some control purposes. Yeah. Now, in this case, let's try to understand as to, what is the understanding between these three partners. So we have Mr. A, Mr. B, and we have C. So there are three persons who have come together. Now let's try to understand the objective of a JV. So why would three investors come together or three persons come together and form a JV? Because they want to pool resources. Maybe they have got expertise. Maybe two persons are capable of providing resources. The third person has got the expertise. So that's why they may have come together. Yeah. So it's like they want to pool their resources, their capabilities, and run a business. Okay. Why? Because by doing this, they will be able to do this in an efficient manner. So that is exactly seems to be the case which these three persons are doing. So there's a business. So let's suppose this is a business, a JV business. Now they have not created a separate company. Please understand. In respect of this business, they have not created a separate company. So they are running a business. Now, if this business requires some material, so A provides. Okay, if that material is available with B, B will provide. Any sort of supervision, managerial work, all of those roles are played by C. Okay. And let's suppose they have agreed. They have agreed that their percentage sharing are, let's suppose A is 40%, B is 25%. Okay, so this is 35%. Let's suppose this is the percentage. Huh? Now, do they have joint control? The answer is yes. Why? Because that's the given understanding. At the moment you say JV, yes, it's a joint control. Now the question arises that what will A do, B do, C do in this case? In this case, when A, B, and C have come together, they have not created a separate entity, but they are running some operations. They are running a business jointly. So they have created a consortium, okay, to run a business without a separate legal entity, without a separate company. So that is what you call as JCO. In which case, if you look at this business, okay, so if you look at this business, so in this business, whatever will be the portion of A, I'm not talking about net assets, I'm talking about whatever be the portion, assets, liabilities, profits, losses, revenue, expenses, okay, anything that this business has got, whatever portion A will have in relation to this business. So what will A do? A will say that I'm fine with my portion and I'll record this portion in my own books. So A is not maintaining any separate books. So whatever are the books of A, so A will keep recording that in its books. Same thing B is doing, same thing C is doing. Okay, same thing is done by all three of them. Now this is what you call as a JCO. And because a proportionate share has been recorded by each investor in their own books, do they need to add that once again for preparation of CFS? Tell me, do they need to add that once again for preparation of CFS? Tell me quickly, do they need to add that once again for any separate CFS? No. Why? Because it's already there in their financial statements. It's already there in their books of accounts. Preeti is saying if they do this, that will be a duplication. Yes or no? So that is what a JCO does. In case of a JCO, now let's look at the features. Let's look at the requirements of a JCO, which you will find. In case of a JCO, what will you have? Each venturer has its own separate business. There is no separate entity for JV business. All the venturers are creating their own assets and maintaining them. Each venturer records only his own transactions without any separate books of accounts maintained for that JV business. There is a common agreement between all of them. That is a given thing for a joint venture. Venturers use their assets for their JV business. Venturers will assume the liabilities for the JV business. Venturers will record their share of expenses which are there in the JV business. any revenue or income which is generated from the JV business, venturers will record that. Understood? Everyone clear on this? What do you understand by JCO? What are the features of a JCO? And why is that called as a JCO? And the accounting requirement is quite simple. Yeah. But anyways, we'll have to look at that accounting requirement. Yeah. But we'll move on to that accounting requirement in the next session. Okay. With the help of an example, of course. But any questions, any doubts if you have in relation to JCO, please let me know. So are you now clear as to what do you understand by JCO? How does a JCO work? What are the features for JCO? Over to you. Quickly. Yeah, everyone clear? Yeah. All right, great. So I think this is it that we can just look at as of now, and we can just close our discussion further on this concept today, because this accounting requirement can be best understood with the help of an example. So that is something we'll plan to do in the next session. So Abhishek is asking, sir, JCO example could be the insurance of vessels. So what do you mean by insurance of vessels? I couldn't understand. So what do you mean by insurance of vessels? So are you talking about the insurance business, that they are planning to get into an insurance business wherein they will do this similar sort of exercise? If that is the case, of course they can do this. Yeah. So every time there is a JCO, there are two important criterias. What are two important criterias? First of all, these three conditions have to be fulfilled. So that is first. And second, features of JCO or the criteria for JCO should also be there. Okay. Clear on this? Yeah. Okay. So I think with this, we can just conclude our discussion. And in the next session, we are going to continue our discussion on the JVs. We'll also hopefully wind up our discussion in the next session on the JVs. Okay. But because we are going to continue on the accounting requirement, we are also going to touch upon some of the questions. Okay. So that's very important that whatever we have discussed today, yeah, so you revise that before we meet next. And I think Hardik has shared the required document. Great. So I think this will help me to understand your question. Okay, so I think I'll be able to now come back to your questions with this. Yeah, sure. I'll look at your questions basis this requirement. Sure. Yeah. Okay, so I have looked at the question. Okay, so I think this has got downloaded. Great. All right. So with this, we can just conclude our discussion. Yeah. All right. So thanks everyone for your time and for this wonderful participation once again. Please make sure that you revise this before we meet next. And now I think you have got some questions. So let me just move on to your questions now. So if you have any specific questions as around some of the detailed illustrations, you can just send it so that I can just come back to you on that. Vivor is asking, sir, if H has 60% in B subsidiary, H also has 30% in C associate, then which companies will form a part of CFS of H? Then there will be three companies. H, of course, B as a subsidiary, and C as an associate. All three. Okay. Yeah. Okay, so I think Vidushi, I'll have to just make a note of this point. Let me just try to make a note of this query that you just shared. I'll have to just go through this document. Yeah, so I've noted your query and I'll have to come back to your query. Okay. All right. Yeah, noted. Done. Your query is noted. Done. Okay, so Kasak is saying it will be minority interest in case of a subsidiary. Not necessarily. uh, because we'll have to evaluate that every time, whether it will be a minority interest or not. Because if that happens to be 60% and that's a JV, and the venturer has got joint control, so maybe it's not a minority interest. Yeah. Dilip is asking, sir, just a minute. So these queries are very difficult to be viewed. Just a minute. Yes, what's the question? Okay, so Vidushi is asking why debt equity ratio calculation. Okay, so I think that's the query. Huh? Okay, so I think you can just write this query in one go. Huh? Very, very difficult otherwise, because I may lose out. Huh? Okay, so I may lose out some of this part. I've just noted your query anyways, but otherwise I may lose out. Okay, yeah. All right, so then I think the other point is from Dilip. Uh, Sir, will a company having subsidiary and associate have to prepare single set or two sets? No, CFS is only one, wherein all the group companies are combined. Okay. But of course, at your level, you will not be required to consolidate all of them. Yeah, so only one of them will be there. Okay, so what I'm doing is I'm just making a note of your queries. Yeah, so seems you are looking at some of the illustrations. Yeah, okay. So done. So I think Tambeshwari has one query which is noted. Then I think Artik has one more which is again noted. This, yeah, noted. Done. All right. So I think with this we can just conclude our discussion. Okay. So thanks everyone once again for this time and for this wonderful participation. Thanks so much. And please make sure that you revise before we meet next. Yeah. All right. Thanks. I think, Nisar, we can just close.